Hi, everyone. Welcome to the Check Writers Room. 3 GPs, 3 angles, 1 hot take.
I'm Yasmin Cruz-Farine.
I'm Shalonda Armstrong.
My name is Sydney Thomas. Let's get into it.
We have a great conversation ahead of us today. We are switching things up a little bit. We are going to feature an interview later in this show with Marlon Nichols from Mac Ventures. But we're going to get started with our 3 GPs and a few hot takes. In this first hot takes segment, we're going to do a round robin version where why don't we do this, Shalonda and Sydney? Instead of doing one hot take, how about we do overrated, underrated, round robin style, and maybe give a few bullet points for each one. An example that I have actually is from Ta-Nehisi Coates. He said recently in an interview that his overrated was intellect, underrated was wisdom, and I think that speaks for itself, and we see a lot of that across the industry. I am going to say overrated is servant leadership in a startup setting, underrated kitten heels. Overrated servant leadership because in a startup setting, we need people to wear many hats, and we need to, anyone who is added to the team needs to be able to think ahead. And maybe their role is operational, but I wouldn't say taking cues or a version of waiting for a leader to be the sole embodiment of a culture. It's not really the right setting for that. So I'm looking for very proactive team members across the board in really small teams. I think servant leadership is great for steady state organizations, but I don't think servant leadership is appropriate in the startup setting. I think that maybe that is something that is a widely held belief, but I think new team members who are overly deferential to the leaders of the founders is not really a great setup for the team overall to move fast. And then kitten heels. I know there's a lot of talk about coming out of COVID and folks, being too comfortable, but I think I'm not really going back to that old, really uncomfortable shoe setting for myself. So I'm gonna be someone who's rooting for kitten heels, and I know that's really controversial right now. So Sydney or
It's
Shalonda?
extremely controversial. I
It
don't
is.
even know if I can get behind that. I am not a fan of kitten heels.
Really?
Um, I am
They're so
not,
cute.
and when you see me in heels, it needs to be minimum 3 inches. And so, like, I know I cannot do kitten heels. No, that is just a no for me. What?
But what if you need to break out into a run?
You
Or
better know how to run in 3 inch heels. I
You
do.
guys are so funny. You guys are so okay. I really do love a kitten heel, and I do love a block heel, and I do love a 3 inch heel. I think there are times and places for all three of these things.
All right, I know we just went off on a hill tangent. Please stay with us, listeners. All right, so I think for me, overrated right now is the customer success managers at early stage. I think is overrated. I've seen a lot of founders constantly want to spend money on ordering or trying to hire a CSM, and I don't think they really understand what they are supposed to do. And then underrated, I think, is really getting that first sales rep hire right to set the foundation for your sales culture.
My overrated is, oh, I remember it now. Having everything together all the time, being so perfectly put together, just type A all the way to the wazoo. That was Sydney in 2023. That's not Sydney of today. There's just too much to do to be too perfect, and you need to delegate. I think this is back to Yasmin's point too. This act of delegation is actually the reward that you get as you get older and more senior in your career. And so you should not have to own everything all the time because that's why you hire other people. And I'd say underrated is and maybe this isn't underrated to everyone else, but it was underrated to me. When I first moved to San Diego, I had a sister loctician who I thought was fine. She was not fine because I now have a new sister lactician who's amazing. And I was just like, what was I thinking? And so find the right sister lactician from day one, stay with them forever, don't let them go. They are just, I don't know, I feel better when my hair looks better. And I'm so happy to have found this lady.
I have one that we would both agree with, which is overrated investors who are jumping many stages ahead to invest outside the
Oh,
scope of how they built their platform. And then underrated is Rory O'Driscoll, our favorite investor right now. I think he is on 20 VC. He's a partner at Scale Venture Partners, and I just love hearing whatever he has to say about the market. And I think he's the adult in the room in this industry right now. So anything Rory O'Driscoll, you've got some fangirls over here. That is underrated.
I'll take that.
Okay.
You're also going to embarrass him. So you know he doesn't like too much like publicity. But Roy, we do love you. And for me, he reminds me of Thomas Keane off of Bloomberg. I just love Thomas and to hear him talk about just to hear him nerd out. I just find it interesting. And then what is overrated for me right now? Oh, the performative nonsense
Yeah,
of
you're not into that right
Yeah,
now.
I am not
you've
into the
never been into it.
performance. I'm
Yeah.
not great at it. If you haven't noticed by now, I am just not the performative type. Um, because at the end of the day, we're just trying to figure out if there's a human in there. So
Yeah, authenticity wins the day with Shalonda. So no need to wear a mask.
please
Mask
don't.
off. Well, moving on to our next segment. We we have a big transaction or maybe small for what it should have been. A transaction in the industry that everyone's talking about. So I'll turn it over to you, Sydney, to walk us through the story we're watching.
Yeah, so big news this week. If you are in tech, Airtable got acquired. Honestly, I was surprised. I think I'll just start there because Howie just put out about 6 months ago. I follow Howie on. Howie Liu is the founder of Airtable, fellow Duke grad, go Duke. And, he has been, you guys are so silly. He has been really trying to transition Airtable into this AI economy. He put out a pretty long memo online a few months ago about this transition that Airtable was making. So I was hopeful that they were going to figure it out and become more similar to some of the AI tools that we now have access to, because when Airtable first came on the scene about 10 years ago, they were the disruptor. They were telling Excel to not get complacent. We have a new data analyzing tool on the market, and this data analyzing tool, meaning Airtable, can not just analyze numbers, we can capture images, we can have a lot more interoperability between sheets, we can output forms, we can just be so um, dynamic that we're actually much more useful to the end consumer. I drank the Airtable Kool-Aid and completely believed it, built a lot of tools on Airtable. And, in the Zer pipe, that type of dynamic building and creativity earned them about a $12 billion valuation. Fast forward today, they got bought for about 2 billion, which is a huge haircut to them. But I also think, the bigger picture is that this is a wake up call to all of the ZERP era SaaS companies. Most of them were not as good as Airtable. Airtable, to me, was one of the unicorn media darlings of 2021, 2022. And so if you weren't competitive to Airtable and you think your valuation still stands the test of time today that it was in 2021, you got to think again. And so I think that this is the real unlock from the Airtable acquisition is that the data is public. A lot of times the acquisitions are privately marked, and so the public does not have access to what the value of these companies truly are or what they're actually valued to be on the market, which I think is a gift to the industry. So we can start repricing from a more grounded perspective.
Yeah, I wonder what was in the books from a Mark's perspective for Airtable. But just to walk folks through, Airtable raised $1.3 billion, and the seed round happened March 2013, and it was Caffeinated Capital and Founder Collective. Love FC. The early venture dollars, they'll probably be fine, but the it's probably an 89% markdown from the last primary mark, which is a significant haircut. But I do think, Shalonda, I'm curious what your take is too, that this horizontal workflow SaaS space, this is a good showing because there was still significant revenue coming in for the valuation that they're ultimately getting in this Bending Spoons acquisition. So it was like 480 million in rev for,
Yes.
yeah. So I think the dynamics there on that exit, it's quite interesting. What are your thoughts, Shalonda?
Yeah, so just to level set, to Yas' point, they raised about 1.3, and Sydney's being kind on the sell price. They're selling for about 1.3. And that
There's
multiple,
some cash on the balance
it is
sheet.
an all
Yeah.
cash deal,
Yeah.
which is an upside. I would also just say, the rev is 480 million, and to sell at 1.3, I mean, we're talking a 2.5 to 3x markup on revenue. That's a private equity type of return, right? So this is a different type of acquisition. Is it a fire sale? We don't know. We don't want to make any accusations here. But it's a little low, I think, for the level of visibility that they had, that they absolutely do have super users and people who love the platform like Sydney. I can attest, Sydney loves Airtable. She does everything in it. um,
But maybe not
and
anymore. I mean, that's why I'm kind of sad. It's like this might be they might turn it into a feature at Blending Spoons. They
it
might
could be. I
pivot.
think I think they're going to have a feature moment, right? We'll have to wait and see. I think the other part of this is, as much as they try to pivot to become an AI first company, it wasn't quick enough. And I do think that we are going to start to see a lot of these SaaS companies figure out their exit ramp. If you are a pre AI company, find your exit ramp, because it is going to be very hard for you to justify growth stage capital right now, especially with these type of multiples on an exit. So I think this is unfortunate. I hope that this is an outlier, but I believe that this may actually start a pattern that we're going to probably see for a little bit until the market starts to find itself, I will say, with these markups.
And Bending Spoons, this is their strategy to acquire quote unquote legacy asset. Wow, Airtable's a legacy asset. I mean, it's been private for a long time, so maybe that's also justifiable, and fits the trend of what happens with these companies that have stayed private for so long. Bending Spoons IPO'd in last month, 2026, and started acquiring assets prior to that. So I'm curious, kind of, are we going to see more of these type of kind of buyers, or who has an extra Billy
Right.
to scoop up enough of these that are sitting in portfolios is also going to be the question.
I mean, SpaceX kind of just did that with Cursor. It's like, is there going to be this like new almost bifurcation between the companies that can go public and the companies that can't? And the companies that can go public then have a lot more cash on the books that they can work with to purchase some of these companies that just didn't go public when they should have. I mean, because maybe the lesson too is that Airtable should have gone public 3 years ago, 4 years ago.
There's also, I do think that we are going to see this because we have over 1,000 plus unicorns in the market right now. And there's not 1,000 places for those unicorns to land. And we're not even talking about the AI companies yet. So those are decacorns, right? That they're trying to get their multiples on. So I do think that we're going to see a lot of this. Now, are we going to see 90% haircuts? I don't know. But I mean, and then there's also the question of how sticky is your revenue? And I know they're doing around 500 million in ARR, but I'm sure that there's going to be some scrutiny around how much of that is really enterprise revenue and how sticky is it?
Yeah, all good questions. Uh, I think that we'll continue to watch this for sure. It's definitely almost a test transaction for the market. We'll see. We have what Cursor was 60 billion,
Yep.
and now we have Airtable reading rainbow color spreadsheet, no code workflow tool now at 1 billion to 2 if you count the cash value. So we'll continue to see how the pricing works around the industry. And we have a final segment actually. Would you write the check this week is a little bit different. Marlon Nichols from Mac Ventures manages about 600 million in AUM, is an early stage firm. And Marlon talked to us about physical AI. So our Would You Write the Check segment this week features Marlon, and we're going to cover physical AI. We hope you enjoy it.
And we do have a fun ending joy moment too. So you'll get some of our joy at the end of the show. So listen till the end to hear what we're excited about this week.
We hope you have a great week. Bye.
Hi everyone. Welcome to the Check Writers Room. 3 GPs, 3 angles, 1 hot take.
I'm Yasmin Cruz Farine.
I'm Shalonda Armstrong.
My name is Sydney Thomas. Let's get into it. We're really excited to have a special person in the room joining us, Marlon Nichols from Mac Venture Capital, who is, in my perspective, a bit of an OG in this ecosystem. We're really grateful to have him on the pod because he actually just released a state of the market on the heck is going on in VC. If you've been listening to this podcast, you know we've been talking about this exact question for a few episodes now. And so we're really excited to get into it with someone who has seen a few cycles, or to get some clarity on what this cycle is teaching us, what we have to learn from it, where do we go from here. So I'm going to give a bit of an overview of Marlon's background, which is that he is the co-founder and managing general partner of Mac Venture Capital, a leading seed stage firm renowned for backing visionary founders who redefine industries. He has grown it alongside his co-GPs into one of North America's largest seed stage venture firms, surpassing 600 million in AUM. We're really excited that he's also on the board of Kauffman Fellows. That's how I've gotten to know him well as a fellow Kaufman fellow myself, and I know Yaz feels the same way. So without further ado, let's get into it. Welcome to the pod, Marlon.
Thanks for having me. Great to be here.
Awesome. So, let's just jump right into the deep end here. In the state of the market, uh, first, actually, let's tee it up a little bit. Why did you think it was time to write a state of the market report? What is it about this market that needs a, report?
Well, it was a selfish thing, really. So we were in the middle of one of those cycles that you do as a fund manager. Won't say which one, since this is going to go live and all over the place. And we felt like LPs needed a reminder of where we are, and that these things move in cycles. And there's also a lot being written that venture is dead and the model doesn't work anymore. And we just thought, look, let's just kind of reset and reground everyone to what's really happening here. Venture is fine, it's healthy. We're experiencing a liquidity issue in this moment in the cycle, and that liquidity issue will eventually be resolved, and capital will start flowing back to venture firms, and then venture firms will start sending capital to founders, etc. So that was the rationale for writing the report.
It makes a lot of sense. And something we've talked about here too. I would love to get, um, you know, I think the most interesting part of the um, report for me was this framing around the other 80%. And so would love to hear you dig into that piece. What is the other 80%? What, why is it interesting to invest in that, um, you know, community of companies now? And like, how did you spot this?
So the 80% it essentially speaks to the real economy. So manufacturing companies and entities like that. And traditionally, when you think about software or startup penetration, sales penetration, it's not into those companies, and there's good reason for that. It just wasn't helpful to them, right? So sure, they might have bought some ERP solutions or things like that, but nothing that actually drove their business forward, from their core functionality perspective, or or would help them to significantly resolve issues before they arise. That didn't exist for them before, so it didn't make sense for them to buy software, essentially. Well, fast forward, now we have all these sensors, and with those sensors come all this unstructured data, and now comes AI, which allows you to make sense of that unstructured data, and also allows you to do a lot of forecasting and see things in advance of when they happen. So now a factory can buy, I'm going to call it software AI, that can help them figure out a week before it happens that a manufacturing line is going to go down, and they can put things in place to make sure that doesn't happen, so they don't lose $100 million in a week, right? And so now that's interesting to them, right? Now it makes sense to spend some of their capital on that, right? To prevent losing that capital, losing customers, etc.
For our listeners, digital AI is kind of the software, the easier part. You know, all things are hard, especially in venture, but we'll say maybe perhaps the easier part. And you're talking about the part that's not digital, engaging with this 80%. That's the real economy. But one of the things with kind of these incumbent larger these large industries, which we're excited about too at Visible Hands. And you and I, Marlon, have co-invested probably in each fund on a few things. You've been a great supporter of the firm and sharing deals with us. So we agree, but just to sort of poke some holes, maybe for the audience, R&D cycles can be longer. These can be more capital intensive sectors. So how do we think about the VC model when some of these dynamics are a little bit different?
Yeah, I think it depends on what you're investing in. I think we're going to talk about kind of the bifurcation of venture a little bit later, which is the 400 million in sub funds versus the multi-billion-dollar funds, and what one is investing in versus the other, right? And I think your question kind of speaks to that a little bit. There's a lot of investing going into research projects, billions of dollars going into research projects, right? That don't really have a product; they just have minds, right? That's what they're investing in. There's no end in sight in terms of monetizing those research projects, right? So that's one. We like to focus on companies that are maybe 3 to 5 years out from a monetization inflection point, right? Where whatever it is that they're building, they will be able to commercialize it within 3 to 5 years, right? And if they can do that, now you're falling within the confines of the typical venture model, which is a fund is 10 has a life cycle of 10 years with probably 2 1 year extensions, right? You can actually get to a point where companies will mature enough from a financial perspective to generate some form of return, whether it be a full IPO, full acquisition, or something on the secondaries market. So it depends on what when you get involved, and what you're looking at. So like right now, as an example, there's a lot of chatter and excitement around, humanoids, those robots, right? Well, that's cool, but I'm not prepared to invest in humanoid right now, right? What I'm investing in is our robotics that can change the way that food is manufactured, or something like that. Like take our company Chef Robotics, shout them out for that. But those are the types of things that we're investing in. And while we're not afraid of hard things, we're also doing a lot of software investing, in the physical AI space as well.
And Marlon, I know you're in the physical AI space, and there's definitely a lot of excitement around that space. I actually love that space too. I'm not as, uh, I don't have the appetite like you do for that right now, but I would love to get your thoughts around how are you thinking about the actual revenue models to support physical AI and how to make that sticky. As I know, on the software side of AI, we're still trying to make sure that we have an understanding of really where the revenue is coming from, and we're not double and triple counting it with the other models that it may be running under it. So how are you thinking about that in the physical AI space?
Think there's a finite number of revenue models, and you just got to apply the one that makes sense for that company, right? So it's there's still some level of buying a certain number of seats, and there's certain level of what we used to call database hits, is now replaced with tokens, right? Same thing, just I don't know, framed differently, right? So I don't think there's much change in actual business models.
Which IPO, if you had to point to one, really opened the floodgates for capital into these types of companies? Is it because maybe it was Nvidia with chip manufacturing, maybe it was SpaceX with the infrastructure that they're building, maybe it was one as far back as Tesla. But I'm curious to hear your thoughts on like what is going on in the public markets right now that is helping you make the case for this on the private markets too.
Yeah, well, I mean, SpaceX just went public, so we can't credit them with that. I actually don't think it's the what's happening on the public markets that's driving this. It's there are a few things that have happened, right? I think it's gotten cheaper to build physical things. One, I think the integration, like the relationship between physical things and software, has gotten a lot better. I think the advancement in agentic AI has contributed to this a bit as well. As I mentioned, like taking all this unstructured data and making sense of it, and creating outcomes or product from it. I think all these things are helpful. And if you really think about venture, like, and you go back in the day, like I used to work at Intel Capital, for instance, like, Intel was a venture-backed company at one point, right? Apple was a venture-backed company at one point. Most of the venture-backed companies, like back in the day, they were building physical things, right? It's just over the last, call it 20, 25 years that we shifted to, the software cycle, right? And I think like we start, the way we started this, like this whole thing moves in cycles, right? So we went away from the hardware, went to software. Now we're coming back to the hardware, and and we're trying. Some folks are trying to pivot back to some version of software already. So it's not new. It's not totally new. It's just I don't know, call it reincarnated.
And Marlon, I would love to get your thoughts on with hardware. I've heard some conversations from other fund managers that hardware definitely is a space that needs a little bit more love from the venture lens and more dollars put there. But I'm also seeing a lot of hardware coupled with services, which has traditionally been a no-go for venture dollars. What are your thoughts with hardware coupled with services? Do you see more companies moving to that model as well?
So services has always been hard for venture, right? Because you can't scale it. You can't scale people, essentially. I think in this new world where um, AI in some ways can mimic the behaviors of a person, or at least the way that it moves through logic. I'd say, right, is closer to you know um, what a support person would do, right? They're going through their script and they're doing certain things based on what answers they get, right? AI can do that. So it presents an opportunity to scale services to a degree, right? But I don't think anyone is getting excited about investing in a hardware company that also employs an army of people, and they need that army to get large, that army of people to get larger.
Yeah, I think some of that is kind of like integration, right? And understanding that role in some of this. But one of the things we need to also think about is in, I think it was an SVB report on hardware that just came out or in the last quarter or so, that global venture dollars into hardware has more than doubled in the past 4 years. And so, you know, I don't know if we should call it a trend if we're kind of maybe piling on, if went from 9% on the US venture side to 22% now. And I think this is an important call out because, Marlon, some of what you've built your career on is the ability to spot trends before the crowd gets there. So if you are, for example, a founder now, building in this sort of space, you know, 5 years from now, what should they already be doing as our resident, you know, trend spotter? What should they be thinking
you know,
about
the the
building?
the one kind of cause that I didn't mention earlier is government spending and defense. A lot of that hard tech spending is from the government, right? This is kind of a newer thing where, back in the day, like as a venture professional, you would not be excited about a company that's selling to the government because the sales cycles used to be so long, and the process of approval was just so tedious that it didn't work. But there's a real need in defense to move quickly. And I guess I'd say one of the things that this administration, one of the few things this administration got right was to, kind of make it easier. for private companies to work with the government. So that was also a cause. To answer your question, this question, I you know AI is probably, well, it's been touted as, the most important innovation that we've ever seen and may ever see in our lifetime. And I believe that's true. But what else is true is that it's capped right now. It's not in a position where it can realize its potential. And so you say why, right? Because if you look at it, it's doing very great, very well in consumer, right? ChatGPT is, everyone is asking Chat or Claude or whatever for
Way too
something,
many things. Yes,
right?
they're asking them too many things.
Right, and that's easy, and there's not a whole lot of regulation there, and there's not a lot of immediate risk to a company's top or bottom line, right? These are just humans interacting. Where AI has been limited or throttled is in the enterprise, right? So you think of like financial services or healthcare, right? We don't have the monitoring or the security elements that would give you know Jamie Dimon, for instance, the the what do you call it, the feeling of like, yeah, this is cool. You can roll this out throughout all of J.P. Morgan Chase, and we're good to go. Like we are so far away from that, right? And then there are infrastructure constraints as well. So energy, so many people have talked about compute. A lot of folks have talked about cooling. Folks have talked about, right. So until we get those things, in a place where it's the cost is not prohibitively high for companies to use AI in their operations, and that they can feel secure, and that there's enough energy to power these data centers that host the machines that the AI needs to run on. Until that happens, like we're bottlenecked, right? And so that's where I see the opportunity. It's kind of the call it picks and shovels to make AI actually reach its potential.
Hmm.
I actually love that, 'cause that's kind of where we are looking at as a firm as well, with kind of that picks and shovels of the AI infrastructure. But then, we have situations, as I'm sure you are well aware, with Fable rolling out, and I've heard at least of 5 instances of folks, AI agents, that have gone in and gone rogue on their desktop for various things. And now there's this fear that has come with your AI agent actually may go and do things that you told it not to do, it still may do it. And so when you think about physical AI, what additional guardrails are needed for the safety and compliance for physical AI?
It's the same thing, and the stakes are just that much higher, right? Especially if those machines are near humans, right? It's just yeah, it's just something we have to solve for. We one of an investment we made earlier this year is a company that's actually just built to monitor agents and stop them when they start doing things that they're not supposed to do, right? So I think from a software perspective, we're gonna have to see a lot more of those types of companies before folks are truly going to get comfortable with wide scale rollout of AI.
It sounds like a really important innovation, especially in this space as we are touching now, building in this more like human world. I'm curious, like, would love to hear more about the last mile thesis around like where this 80% stays, like integration into legacy ERPs, banking, hospital systems. You touched on it a little bit with regards to like what is Jamie Dimon willing to roll out and what isn't willing to roll out. Where do you think are some of the big opportunities in some of those areas with regards to last mile.
So we're spending time in alternative energy solutions. So we're doing nuclear, we're doing newer versions of solar that actually work for businesses that don't have a ton of real estate. Um, we're doing we're looking at rare materials, right? So that's all on energy side. We're looking at battery optimization software, right? Because when you um, introduce alternative energy, you've got to store it somewhere before you can release it. And so I think we're going to see a lot more around batteries, and it, the actual hardware around batteries is not as interesting to me as leveraging AI to improve production, distribution, and harvesting, and all that stuff. So those are some areas where that I mentioned. I talked about kind of the observation and monitoring stuff. Basically, I guess the blanket layer is security, right? I think there's a lot of opportunity within security for these things, and then kind of reindustrialization, and this is it's kind of robotics, but it's not humanoid robotics. It's robotics that you know um, physical machinery that's becoming smarter because of AI that fall within manufacturing, construction, etc. So that's just a few. Another one is quantum. So quantum computing, and this one's a little tricky because we haven't figured out, are we 3 to 5 years out from true commercialization here, or are we still about 10 years out, for this, and the reason why quantum is important. Folks are building these massive data centers, and they're putting all these chips in there, and the more that you put in there, the more cooling you need, the more energy you need, and quantum could make it so that for the really complex equations and challenges, you're using much smaller, uh, I guess you call it chips because I don't have a better word right now, to do that. And so that would require, I guess, less space, less energy, less cooling, if you can pull that off. So I think there's an opportunity there. I just don't know, haven't figured out if we're where we are in the cycle yet.
I think I've narrowed down kind of what a founder should be building. Anything that's glamorous, no, do not show up, because we're in a very unglamorous infrastructure part of the cycle, and that's probably what a founder should try to get in front of us with. But I hope, Marlon, that you're right, because we have a co-investment, and if it's 5 years away from commercialization, then I'm excited. So, but some of this though, I still worry that it means, and this kind of points to kind of this uneven market. I mean, Marlon, you're kind of been in multiple firms, and you're in multiple funds, 600 AUM in this firm that you're building with your co-GPs. But some of this, do you think, will require kind of like the 5 to 10 firms that have AUMs that can write the checks, will it require more rounds, right, in terms of a dilution perspective? What are some observations you have about kind of the sub 500 million? Where do you want to put the break point? You tell me. And then kind of the few firms that can capitalize some of what everyone's looking at right now.
I'm actually excited that these multi-billion-dollar firms exist, right? That have to write massive checks. That's great, right? Because they're gonna have to spend less time in in the companies that require you know 10 million to 20 million to to really make a dent in what they're trying to build. And then I think it there's a natural progression where those companies develop and and create value, and now they're in need of raising hundreds of millions of dollars and even more. And I think that's where these kind of I call them index funds now will play, right, because they have to write those massive checks. And you know their which means that their return profile is gonna be a bit different. I think it's gonna look a bit more like private equity or growth, right? Like where two, three, 4x versus the 10, 20x's that if you hit a home run you find in an early stage venture. And so I think it's great. As long as they don't come to kind of our playground and price things up, way more than they need to, or if they're not responsible in terms of valuation and just other things that you know that deviate from the fundamentals of creating you know healthy companies.
Hmm. I think it's a really interesting point around like what do the round sizes look like now that need to exist in order for us to support these companies, and with the capital that they also need to scale. I think Carta did a recent article on this, and I'm gonna butcher the actual size of the average seed round. I don't remember it on the top of my head, but I think it was in the 15-ish million dollar range compared to 10, honestly, maybe even 3 years ago, where the average seed round is more in this like 3 to 5 uh, range. What are you seeing in like what size rounds are you seeing need to exist at the seed stage for some of these companies? Um, and does that impact your how you think about the fund math from Mac's perspective?
Yeah, I'm seeing more 5 to 10 million, um, the seed rounds,
That's
and
great.
yeah, and the higher ones, that's because they are building physical things. But like there's like you're a software company or an AI company. I mean, what do you need $10 million to do in the very early innings, right? And if you got to pay that much um, for talent, then I don't know, or you the right people to be building this thing. You question that, but it's you got to play the game that's on the field, right? So you just got to figure out what makes sense for you, and for us, like we just try to pile on the ownership in the beginning, knowing that it's gonna, for our capital intensive investments. We try to get as much as we can early, because we know that as it matures to a certain point, like our dollars are going to be meaningless, essentially, and we're going to experience dilution. So we want to try to capture as much of the ownership up front as we possibly can. Like I think gone are the days where you can play catch up in a successful company.
Given that we all know the dilution is going to come, given that we've seen even Anthropic, I think the CEO still only owns 1% of the company after all the dilution. Um, where do you think is the sweet spot? I know typically in seed it's been that 8 to 10, and now do we have to get comfortable with 2 to 5% with bigger checks, and that's just kind of the world we're going to play in now, or
I don't think so. I mean, we're still going after 10 to 15%. Because again, the name of the game is ownership, right? Like 2% of a billion is very different than 10% of a billion, right? And you have to do venture fund math to make these things make sense. Like I had a conversation with LP recently, and he was telling me that they're targeting firms that look for 15 to 20% ownership, and and they're not investing in anyone that's not where that's not the target, and they recognize that this might be hard to get to in today's environment, but it's what it's how they see the math working, for the stage company, the venture firms that invest at the stage that they want to be in. And the other thing too, right? It's gonna sound like I'm speaking out two sides of my mouth now, but for some of these very capital intensive companies, their upside is just way more massive, right? So instead of looking at trying to get 10% of a company that could be worth 3 billion, you might be looking at, okay, well, what is 2% of a company that's worth 50, 100 billion look like? Like that's becoming more and more of a reality.
It's such an interesting world where it's like, yeah, we're looking at T's now, not just B's. And so this the absolute number, like from a market size perspective, is continues to grow pretty significantly, cycle over cycle.
Yeah.
Well, I feel like we dug into it, like the meat of the meat and the potatoes of it. And so thank you so much, Marlon, for taking us to the research that you've done and giving us an insight into what you're really excited about. I want to flip the script a little bit and transition into what actually are you excited about from a personal perspective? What is giving you joy? We can, I think, maybe the I can kick it off. Um, we are in um, peak outdoor concert season in San Diego. Like every single, I wouldn't even say it's every weekend. It's at this point almost every day. There's an outdoor concert and a park somewhere in San Diego, and so it's been really fun to um, check them all out. I was actually about to go to. I don't know if you went to this. The California African American Museum had a concert on Saturday night. Novena Carmel, my favorite DJ from KCRW, was spinning, but I didn't make it up to LA for that event. But it looked like so much fun. So I feel like it's a SoCal thing. I don't know. What do you what is LA like these days for you, Marlon? What's giving you joy?
Concert culture is a real thing, and it's coming back. We are definitely in the post-COVID era where experiences matter, and people want to be around other. I'm at a point where I'm doing a lot of like reconnecting with friends and family members and prioritizing spending time with them, and that's been really like fulfilling. So I'm looking into to doing like more of that, and finding a way to um, I don't want to say not work as hard, but um, you know find more time for those things because they matter.
Well, I've been traveling quite a bit all around, around the East Coast, and I've got more of that to do over the course of August. But one of the things that I don't know if you celebrated this, Sydney, but it was James Baldwin Day recently. And
What?
so yes. And there's a famous James Baldwin quote that Sydney has reminded us of, which is, those who say it can't be done are usually interrupted by others doing it. So I'll leave you all with that. And so, bringing me joy, revisiting some of Baldwin interviews I saw posted. Those are the grainy black and white ones. He's often smoking cigarettes, but seeing some of those have brought me joy in the last week. All right,
Okay.
Shalonda, what's giving you
All
joy?
right.
You're
All
up
right.
now.
Okay, you can't leave me after the Baldwin day and then you're gonna leave with a Baldwin quote. Like, what? I
So
don't
You
have.
should have
Mark,
gone before me.
I You know what? It's August. It's August. Um, and fall is coming, but you've made it like we've made it through another summer. And so
Don't
that's
no, don't say that. We can't. Summer is not over yet. Summer is just getting going.
Yeah, we've got so
Do
many
not call
beach
it.
days. What are you talking about?
Literally.
Yeah.
okay. All right. Guys, it's August. It's August, right? You're going to have to start letting go, right? No? Okay. All right. Well, that's what's bringing me. I know that fall is on its way. We will soon have football season upon us. Um, and
Yes.
so, yeah, that's bringing me joy.
So one of the things that I love about a Marlon Nichols email is his sign off, and it's just one word: success. So maybe that's the best as we go into September. We're hoping everyone is feeling successful. So it's success MN. So that's probably the note we should leave this on.
I
love
love
it.
that. Marlon,
Love it.
where can people find you if they want to learn more about the State of Market Report, about Mac Venture Capital, about you?
Yeah, so the State of Market Report, we put it on our website, so it's just macventurecapital.com. And on our news page, you can find our insights, and it's one of the things listed on the insights page. And then I'm on all things, I'm just Marlon C. Nichols.
Awesome. Thank you so much for hanging with us today. We're excited to. This is a great conversation to dig into what the heck is going on in the world, and we'd loved having you dig into it with us, and we'll talk soon.
Yeah, this was fun. Thanks for having me.
And that's the Check Writers Room. Special thanks to Natalia Skoko for editing. Subscribe to our newsletter and view show notes at checkwritersroom.com. Leave us a review wherever you are listening.